All right, afternoon, everybody. I'm going to give it about 30 seconds here and get it started. This is Don Winter, CEO of DLP Capital, and excited to chat with you this afternoon. All right, everybody. So we will get started now. So again, Don Winter here. What we're going to be talking about today is the topic that should be near and dear to everybody in this webinar, to really anybody who's investing capital, which is risk. And we're going to talk specific to real estate, but really a lot of what we're going to talk about today, we're going to talk about three different types of risk, and really you could apply these three types of risk that need to be considered in any investment to certainly any real estate investment, but any other type of investment, whether it be in a public or private company, real estate, whether it be even looking at bonds and typical treasuries and things like that tend to be considered lower risk vehicles. You still have to consider risk in any investment. But again, we're going to focus here, of course, a bit on real estate, which is what DLP focuses on. So a quick bit about DLP Real Estate Capital here first as a little disclaimer. But I'll tell you a little bit about us for those of you who haven't spoken with us yet or haven't had the pleasure yet of meeting or investing with us yet. And then we're going to dive right into risk. So we have a philosophy and principles here at DLP and how we think about investments. And this ties directly into the topic here today of risk. And our first principle is do not lose money ever. Second is generate as consistent of returns, or in other words, cash flow, as possible. And third, generate the highest returns we can without forgetting rules 1 and 2. So even though you're on a webinar right now about risk, probably the reason you're here on this webinar probably has a decent amount to do with the types of returns you've seen or heard, that we offer. We've been achieving double-digit returns in all of our funds to all of our investors since any funds have been open. So we have a great track record of generating what most would consider very high returns. But what's been way more important and how we focus our investments is we've had no losses to investors ever, and the returns have been extremely consistent. We've had no major fluctuations. You can count on consistency in the returns in each of our funds, which we think is really important, and that the inconsistency of cash flow is a factor that needs to be considered in evaluating risk. A quick bit about myself. I've been in real estate now 13 years. I've closed more than 12,000 real estate transactions. That's over $1.7 billion, including having acquired more than 11,000 homes and apartments. After today, we'll be over 12,000 homes and apartments. Ranked in the Wall Street Journal as one of the top real estate professionals in the U.S. each the last 6 years, #1 in Pennsylvania, New Jersey. Own currently over 10,000 homes and apartments with our investors. And I'm the founder and CEO of each of the DLP family businesses that you see there on the bottom of the screen. Here's the leaders who drive results throughout the organization. It's a growing list, most newest being Dominique, who's our new managing director and senior counsel. But 23 senior executives here driving results across DLP, a part of our 350 plus team members we have in the organization. And actually the newest is actually at the bottom right, Evan Brody, our new corporate controller, who actually started on Monday. So let's dive into risk now. So first category of risk I want to talk about is market or strategy risk. And you need to invest in a strategy that's going to make sense for the duration of your investment. So you need to think about, if I'm making an investment here today, how long am I being forced to be committed for, meaning what's the term of the investment structure, the commitment, and then how long am I thinking about the horizon of this investment? So let's say even if it's a fairly liquid investment, what's the horizon you're thinking about the investment, and need to consider over the horizon of that investment, does this strategy make sense? So, the other day I was at a CVS, and they had one of those red boxes out front. And, I hadn't paid attention to those in quite some time, and actually saw some people taking out a movie, and it made me think, that topic. I mean, people obviously are still renting movies at red boxes, but that percentage of people that are going to go to a Redbox and rent a video when there's Netflix and Amazon Prime and Hulu and on demand on cable and so forth is going to be a drastically reducing segment of the market. So, investing in Redboxes as an example, which they still sell, these Redbox franchises, probably doesn't make a whole lot of sense, right? That's probably not a strategy, especially if you're thinking about this as a 5-year, 7-year horizon. That's probably not a wise investment. And I may be missing something with the strategy, but from any way I can look at it, why would anybody continue to drive to a Redbox when, especially as 5G comes out and internet speeds continue to grow, et cetera, right? So that's an example of a strategy that really probably doesn't make sense to be a long-term strategy. On a macro level, you need to think about, what's the overall market risk in terms of the overall economy? How is that going to affect this investment segment? So in our world, that's, multifamily real estate is our largest segment, class A, B, and C multifamily real estate. So what are the macro sense? What does the macro market look like for this strategy? How are things going to be? How is the market going to affect things? Supply and demand is a big factor, certainly on a micro standpoint, which we'll talk about, but on a macro level as well. Interest rates is a big factor in the overall strength of any real estate investment and most investments as a whole. So looking at the macro sense, how does the investment look? And then on a micro sense, looking at the regional and local market. So if I'm buying an apartment community in Warner Robins, Georgia, it's great to know what's happening nationally in terms of multifamily and what are the housing trends, and are people expected to continue to trend towards renting versus owning? Is financing expected to get harder or easier, meaning, or is that going to affect more people wanting to own versus rent? Our interest rates, are that going to drive more people to own versus rent? Overall population trends, things like that are all certainly important. But even more important, if I was buying an apartment community in Warner Robins, Georgia, is going to be what's happening in Warner Robins, Georgia. What's the local competition? Are new apartment communities being built? Is population trends improving? Are any new employers coming in? Are any employers leaving? What's happening in the government sector? And Warner Robins, there's a military presence. How is that going to affect things? You're looking at the local sense of employment and population and supply of product are all important factors to consider making an investment in an apartment community in Warner Robins as an example. So you have to understand a deep level of supply and demand. And as you're making assumptions in terms of what's going to happen with supply and demand, what's going to happen in terms of appreciation, what's going to happen in terms of rent, what's going to happen in terms of expenses, what's going to happen in terms of property taxes, what's going to happen in terms of investor confidence, and meaning what will people be willing to pay for an asset when I'm looking to sell that asset. It's really important that you use conservative expectations. So if I believe that the market's going to improve and rents are going to go up by, say, 5% a year every year, I want to make sure I'm making conservative assumptions. If I think that's possible, is that optimistic? Is that pessimistic? I want to make sure I'm making very conservative assumptions. I want to be making conservative assumptions that, yes, real estate market's been great for a lot of years, but if I'm investing in a strategy on a 5-year horizon, is it likely that in 5 years the market's going to be as strong as it is today, that investor demand is going to be as high as it is today, meaning people are going to be willing to pay as high of prices today? Generally, we're assuming that the market's going to be much worse and much softer when it comes time to sell. So those are all things to consider. And I'm going to walk you through an example in a few moments of the difference the assumptions you're making, the expectations you're making can make on the return of an investment. So that's the market risk. Second type of risk I'd like to talk about is the asset risk. So let's use that Warner Robins example. And let's say Warner Robins is a great market and there's a couple big employers expanding operations there and another employer moving into town and military base is expanding. And everything is trending, great population growth. People are moving there. There's no new supply coming into the market, right? All those things could be true in terms of the local market, but it still could turn out to be a risky investment. And that could be due to the asset risk. And first, I want to talk about the buy. So it's really, really critical. The same property in the same market, purchased at the same time, can be a really great investment or not so great of an investment based upon the price. So an asset that's a great price at $8 million might not be a great deal at $12 million, right? Might be very difficult to exit that property and get a return of capital at 12 million, where at 8 million, you're in a really, really good position. In today's market, where multifamily prices in almost every market are at all-time highs, that the demand for these types of communities have never, ever been higher. The cap rates that people are paying have never been lower, meaning people are paying the highest prices. It can get very easy to get caught up in simply paying more to get deals and being more aggressive in your assumptions in order to make sense of that deal. So really, really important that you're buying a deal at a price that makes great sense. We're actually selling a deal in Warner Robins right now, and those numbers I just gave are actually realistic. We bought the community at $8 million, $8.1 million 2 years ago, and it looks like we'll sell the asset for north of $12 million just 2 years later. It was a great buy at $8 million, hence our exit for $12 million. I wouldn't feel so strong buying it at the price that the buyer's going to end up buying it from us at $12 million. But same asset, same market, nothing's changed in the market in any negative way, but the price is dictating whether it's a strong investment over the next 5 years or whatever the investment horizon we're looking at is. So it's really, really important. It can be very challenging in a tough market like today with a very competitive market. The other risks that you have to keep in mind in from an asset standpoint are tie in with the market risk, but again, is the expectation, the assumptions you're making. What's going to happen with revenue? What's going to happen with expenses? What's going to happen with investor demand? Are really, really important components of potential asset risk. Interest rates, market conditions are overall factors that could affect that specific asset. Another big asset risk to consider in terms of assumptions is vacancy. What's the expected percentage of number of the apartments or percentage of apartments that are going to be vacant at any time, being conservative in your assumptions there. And then the other big one here that I'm missing on the slide is the risk in terms of the physical plant, meaning the condition of the asset. Are there any structural issues, environmental issues, any large looming capital expenses that are going to need to be addressed over your course of ownership? In a large apartment community, we could have $1 million in roofs. We could have a $500,000, $1 million structural problem. There's some pretty big expenses that you can deal with, let alone environmental challenges. So there's a lot of potential asset risk, and that's why on every property we buy, we go and get a PCA report, a property condition assessment report done by an engineer, analyzing the physical asset at a deep level. We get a phase one environmental study done on every property we're buying. If there's any flags at all, we get a phase two study done, which we've only ever had to get to one time. We get a full valuation, third-party evaluation in terms of the value of the property and appraisal as well. We go out there and physically walk the property with a large team, walk through every single apartment, walk through all the common areas, get roofers out there to get on top of the roofs, bring general contractors out with us, take a deep dive that we're very confident understanding what the potential expenses we're going to have over the course of our ownership. And that's really, really important in looking at a large asset where you can have millions of dollars in expenses over the course of a 3 or 5 or 7 year investment. And the third type of risk I'd like to talk about, and this one, of course, is near and dear as we are the manager of our investments, DLP Capital Partners, is the risk of the manager. And this, in some cases, you could argue is the biggest risk of all in making an investment. Again, this certainly comes to making investment with a private, real estate fund manager such as us, but it's not much different than the risk of the manager in any investment. And by manager risk, I'm talking about the person who's responsible for the outcome of that investment, who's responsible for the day-to-day. So, example, investing in a public company, investing in say a Facebook or an Amazon, the manager risk is really Jeff Bezos or Zuckerberg, right? I mean, you're taking a big bet in that CEO in their ability to continue to drive innovation, continue to drive performance, to continue to build investor confidence, to continue to make the right decision in a very competitive market. So talking about is really the risk of the certainly the CEO, but the executive leadership team, the manager, the people who are responsible for executing on your investment. So you need to start with, to me, the basic component of this is investing in or with, really good people that you trust in both good times and tough times. And of course, the really challenging part there is the tough times. When things are challenging in the economy, is this person somebody you can trust to make the right decisions, to fight through the challenges, that is going to do what's best for you in those situations. And that's really a test and a question, and in a lot of ways, of character. And that can be a challenging thing to assess, but it's really critical that you get comfortable with the quality of the humans that are responsible for managing the investment. And I've seen so many times, an investment where it was, a good strategy, it was in a good market, it was a good asset, but unfortunately a bad manager who couldn't execute on that strategy. And that can erode everything else being good if you're investing in a manager, certainly, who's not trustworthy and not making, not taking care of his investors. But sometimes it's not even that they're intentionally not taking care of investors, it's inability. But it starts with, trust in the quality and character of the individual. And then second comes to the confidence in the manager to execute. Again, you can have some really, really good, optimistic, positive people who just can't get things done. And that ties back in with assumptions. And one of the ways I like to think about it, so we own a home builder called Bright Homes. And in the world of construction, if you were a home builder, on an Excel spreadsheet and a Gantt chart, I can tell you any home builder, any fund manager investing in building homes can build an average, 2,000 square foot home in 100 days if everything goes perfect. So if weather's perfect, and if there's no delays in permits, and if all the inspections go through without any issues, and if all the contractors show up on time, and if all the supplies get there on time. So if everything goes perfect, we can all build a home in 100 days. But of course, things never go perfect. There's always going to be issues. And that's the examples in building a home, but in any investment, there's going to be challenges throughout that investment. And does the manager have the ability to execute on their strategy in the real world? Because doing it in Excel, doing it on a pretty presentation, that's easy. It's easy to make sense of almost any investment in Excel if everything goes perfect. But can it be done in the real world? Does the manager have the team, have the infrastructure, have the discipline? Do they have the knowledge to execute on the strategy they've set out, regardless of what's going on in the outside conditions? Because there's going to be turbulence, especially over a 3 or 5 or 7 year investment. There's going to be challenges that happen, things that are going to go off the original business plan. Are you confident the manager is going to make the right decisions and then have the ability to execute on those decisions? Is a really, really important question. Doing the due diligence, the manager really have the ability to do so, and do they have the control of it? And that's why we think it's so critical that we run property management, construction management, asset management, brokerage, everything in-house, because we actually have the control to execute, where it's in our control, it's in our under our accountability to execute. We're not relying on somebody else's ability to execute. So when you go into a relationship with a manager, I believe it's really important that you have that clear understanding on who's responsible for what. What are the responsibilities, the expectations, the role of that manager, and what's your role in the investment? What are the other key stakeholders involved in this investment that critical to understand their role and be confident in their ability to execute, such as, if the manager is not, responsible for the execution, is hiring somebody else. It's going to be pretty important that you underwrite the person responsible to actually executing, such as a different management company, as an example. What are the risks associated with the strategy, the manager, the market, as we've just chatted about. Very, very important that you have that understanding before you make your investment. Understanding in terms of your relationship with the manager, who's taking the first risk? Is your money at risk first, or is the manager's? Does the manager get paid regardless of performance? Who gets paid first? So who's taking first risk, but then who gets the money first? Who's responsible for what? Does the manager have money invested alongside of me? Those are all really important questions to understand and get comfortable with, before you're investing in or with a manager. Understanding that what happens if the real estate market declines? What happens if, 2008 happens again? Understanding really how long you're committed, really understanding the period of the investment, how long your money is going to actually be committed. Understanding how the manager made the assumptions to the kind of returns they're telling you they're going to generate. Understanding what the assumptions are and if they're realistic is really, really important. Again, I'm going to show you an example of that in a second. Understanding the track record of the manager, their actual performance in achieving the targets that they set out. Really, really important. It's easy to say you're going to hit a target. It's another to actually deliver and have a track record of being able to do so consistently. Do they have expertise in this strategy, right? So I've seen some times where a manager who's got great experience, say in office buildings, decides to go out and buy, a 400-unit apartment community. And that manager could have a great track record of executing an office, and maybe they'll have the ability to then apply that to apartments. But that's a very different investment strategy. And you need to understand is the experience they have actually apply to this investment. Are they an expert in the strategy? Are they world-class in this space? So there's, example again, multifamily space here, there are hundreds and hundreds of multifamily managers. Is the manager you're going with, you feel they're world-class? Because my belief is when there's a recessionary event, when there's turbulence, when there's uncertainty, the best of breed world-class managers are the ones who are always going to do well. Many may suffer, but the best not only are going to do well in turbulent times, but are likely going to prosper and benefit from the others who struggle. This is it might sound like a strange one, but every manager has a, I like to call the magic sauce, something they feel that they do so great, the magic ability they bring, whether they can get the renovations done at a lower cost, they have some unique technology, whatever it is that they feel that their advantages over everybody else, and why they're going to do a better job. The investment needs to work without your manager's magic sauce. So you don't want to pay for the magic sauce. I mean, it needs to be a great fundamental investment that if your manager is better and does have some magic sauce that they can do better than anybody else, it's going to be a home run investment. But you want the investment to be good regardless, so that if something happens to that manager, you're not relying only on their magic sauce, that it can be executed on by somebody else because it's a good fundamental investment. Last couple slides here on manager risk. So capitalization, this is an important one. And the number one reason that companies go out of business, the number one reason that properties go into distress is because there's not enough capital. They run out of money. So in real estate, it's a capital intensive business. And so if you make an investment again into an apartment community or a large office building or into a company and they run out of money and they need more capital, who's responsible? Are you responsible to have to put in more money? Does the manager have the ability to put in the money even if you're not responsible? Is the investment well capitalized from the beginning to plan for the risk of the capital demands of the strategy? That's a really, really important question to understand. I've seen many times where a good investment could have been a very good or great investment, but they ran out of money and they couldn't execute. So you run out of money in the middle of, if I vacated or have 100 vacant apartments and I go in and I, rip out everything and demo the apartments and I run all new utilities and I frame the apartments and I drywall the apartments, and now I run out of money and I can't put in kitchens and floors, right? That's going to be a major problem. That investment could go south really, really quickly in that situation. So making sure the investment is properly capitalized is really important. So to summarize everything I just laid out here in terms of risk, first is understanding the risk of the market or the strategy. You need to invest in a strategy that makes sense for the horizon of the investment. Second, you need to make sure you're investing in a good deal at a great price and understanding the physical asset risk, the environmental, structural, physical issues that may need to be addressed over the course of the investment. And then the manager risk, and the simplest thing to focus on there that can, in many ways, if you make this decision right, can in many ways take care of everything else, is investing in really good people that you trust to make the right decisions in good times and in tough times. So a couple things on how we mitigate risk here at DLP. So first, on acquiring properties, it starts with having strong in-house management that we control and having very disciplined buying. So right now, prices have never been higher, meaning people are buying properties at the lowest cap rates ever. Often we're seeing cap rates in the 4s, which means if somebody bought the property all cash, they'd get a 4% return on their investment. We're on average over an 8.5 cap rate by the second year we own the property, by the time we stabilize. It's a big difference. That means roughly we're paying about a 50% lower cost than where the market is after we finish our improvements on that asset. It's a big deal. So being very disciplined in buying is critical. Our discipline ensures that we never get attached to a deal where we get caught up paying too much. We use very conservative underwriting to what's going to happen in terms of the market, the asset itself. We focus on making sure that based on conservative underwriting, we can generate strong double-digit cash flow. That way, even if the market's really terrible and we can't sell a property, we can keep generating great cash flow to you as our investors. And then another big way that factors into our ability to mitigate risk is having strong deal volume. And that's where a lot of people end up taking risk, is they have money they need to invest and they don't have enough good deals. So they end up stretching to invest in deals that really aren't strong enough or pay too much. So we're looking at hundreds and hundreds of deals every month, going out and doing heavy due diligence on 10 to 30 deals a month. We're walking through all the apartments and walking the competition, and 5 to 20 deals a month we're putting offers in, and we're getting engineering reports and environmental reports and appraisals and diving really deep, evaluating every lease, evaluating all the historical financials. And we get 2 or 3 offers accepted and only 1 or 2 deals that get through our due diligence process that we actually buy, because the deal works in terms of the price and the overall investment makes sense in terms of the overall strategy and the market. Another way we mitigate risk is by locking in our long-term debt is non-recourse debt. We're locking in conservative amount of leverage on average across our portfolio in the mid-50s. We're locking in a fixed interest rate generally for 7 to 12 years, usually 10 to 12 years, and a term of over 30 years on the loan. Another way we mitigate risk is through the structure of your investment. So in our current fund, the Preferred Returns Equity Fund that's buying apartment communities right now, the fund is always investing preferred equity. And what that means is there's always additional equity, additional capital invested behind the fund and our investors, sheltering the fund and our investors. And then within the fund, the investors, you, always get paid even before DLP earns anything, including our management fee. So on a typical investment we're buying, the day we buy it, we're going to take out a loan for 65 to 75% of the costs. The Preferred Return Equity Fund is going to put in 15 to 25% of the deal. And then there's going to be common equity invested behind the fund for another 5 to 15% of the return. And I'm going to walk you through this waterfall. And for some of you, this might be a little confusing if you have never kind of looked at something like this before. Hopefully, I'll be able to simplify it. But if not, we can certainly follow up with you on it as well. But hopefully, it'll at least demonstrate the understanding. So let's say we go out and we buy an investment property for $10 million. We may go out and take out a loan for about $6 million. The Preferred Return Equity Fund could put in about $3 million. And then we put common equity, which is money invested behind the fund, for another at least $1 million. So let's say that's the investment. Buy it for $10 million. The Preferred Return Equity Fund puts in $3 million, and common equity puts in $1 million. And let's say that investment generates a $400,000 cash flow. So that's cash that's returned after paying all of our expenses and including the debt. So here's how the waterfall would work. The Preferred Return Equity Fund, which put in $3 million, would get the first 9% return on its investment. So 9% return on $3 million is $270,000. So the first $270,000 in cash flow all goes to the Preferred Return Equity Fund. Out of that $270,000, the fund investors get the first 7% return, which would be $210,000. So the fund gets all the cash flow until the fund gets 270 grand. The investors get all of the returns until they get at least 210 grand. So in this example, we generate 400 grand of cash flow. If we only generated 200,000 in cash flow as an example, the fund investors would get all 200,000 in cash flow. DLP would get nothing and the common equity would get nothing, because the fund gets the money first and the investors within the fund get the money before DLP. After the fund gets their 7% return, then DLP gets its 1.5% management fee. And then DLP gets a split of the profits, 80-20 split. And then after that, only after all that's been paid, would the common equity get their 9% return on their $1 million, would be $90,000. So and then anything above that would be split pari passu. So all the remaining cash flow would get split. The fund gets money on their return, which is split 80-20 between DLP and the investors. So the important point there in a deal like this, where there's good cash flow, the fund gets all the money first and everybody gets a good return. But in a deal that doesn't produce enough cash flow, the fund investors get all the cash before DLP earns anything, before the common equity gets anything. And the same thing applies when we sell the property. When we sell the property, all of the profits out of the sale, all the money that comes out of the sale, the preferred return equity investors get all their money first, get a 12% return on their investment typically first, before DLP earns anything and before the common equity even gets their money back. Just a way of us sheltering even further the investors to ensure great consistent cash flow and no losses to our investors ever. Just ways that we demonstrate the principles. We focus on why we've had 0 months ever of missing our cash flow to our investors, and we've never missed our return targets in any of our funds to our investors. So let me walk you through one of the investments here in the preferred return equity fund. It's actually our largest investment. This is called Lorenz Place in South Bend, Indiana. And there's some pictures from when we bought the community. It's 740-ish apartments in South Bend, Indiana, big, huge clubhouse. Here's some pictures of the inside of some of these units. Here's some of the renovated units. And I want to show you kind of how we underwrote this deal. So if you just looked on the left side of the screen right now, ignore the right side for a second, you'll see the assumptions we put in place when we bought this property. So we assumed that rent would go up 2% a year. We assumed expenses would go up 2% a year. The market over the past decade, rents have gone up 5 or 6% a year, but we're only assuming 2%. Even though right now this property would sell for less than a 6% cap rate, we assume when we sell it in 5 years, it's going to sell at a 7.5 cap rate, a much lower value. We assume that vacancy will be 7%. And with these assumptions that we made, the property will produce a 20.1% IRR, levered IRR. It'll produce a 10% unlevered IRR, which is effectively the cap rate. And we would return a little over 2 times everybody's investment in 5 years. Pretty good investment, right? And that's how this investment shook out. And these were all based on very conservative assumptions. We'll deliver a 20% return. Now that's still a very good investment. Now, if we were to get a little more aggressive with our assumptions, let's say we assume rent went up 4% and expenses only went up 2%. Let's assume we could sell the property at 6 cap rate where we could sell it today. And let's assume vacancy is only 5%. Let's assume we sell it in 3 years. We accelerate the sale. It would end up producing a 54.1% IRR and a 3.67% multiple. Of course, that sounds even better, right? And that would be a much better return. And hopefully we hit those types of numbers. We're not assuming that. We're not making that expectation. We think that's really aggressive. But that's how we see a lot of other managers present deals to investors, with these kind of very aggressive assumptions that drastically change the profits. So in this example on Lorenz Place, hence why we bought it, it's a great investment even with the conservative assumptions we made. But most investments, when we run it through our assumptions, the investment's not a very good investment. It's very common that we underwrite an investment that would produce a 5% or 6% total return. Yet the way the other manager who's underwrote the deal initially brings it to us, it looks like a 30% return. And that's the scary thing. I've seen deals that literally, the way we underwrite, they lose money, but based on the way the manager presents the deals to their investors, they're making 20-30% returns annually. All based on the assumptions they made in what the performance of the property is going to be, what they're going to be able to sell it for, what kind of occupancy they're going to maintain, how much rents are going to go up, et cetera. It's really, really important that the manager has reasonable expectations and then can deliver upon those expectations. So with that said, I'm going to open up the mic here for questions. Kyle's going to go ahead. If you type them in the chat box or on YouTube or Facebook, he's going to ask those questions out to me verbally. And then from here, if you'd like to follow up and learn more, you can reach out to Larry on the screen there, to myself, or go to dlpcrowd.com to learn more. Check out the assets we own here, check out our different funds, and better understand DLP. So Kyle, the floor is open to go ahead and with the questions.
Awesome. Thank you, Don. And thank you everyone for joining us today. We have a few questions here, but feel free to get in the chat there and ask away. We'll get Don to answer all of them. Bob asks, do you put the same conservative estimates or valuations that you use in real estate investing to the DLP growth side of things as a company, the way that you've scaled your business?
Yeah, great question. And the short answer is, absolutely. So, we make we do our financial goals we set each year, generally based on a 20 to a 26% expected increase in revenue and growth. And we base our budget in terms of the expenses, based on achieving a 20 to a 26% growth each year, which to most people, they consider 20 to 26% growth in your business pretty aggressive. But we've averaged over a 70% annual growth. So we budget and base expenses on growing 20%, yet because we're conservative in the results we're going to get on our activities that we do, on our marketing expenses, our ability to execute, we end up getting much greater results year over year than what we budget for, hence our larger growth. And of course that drives, better profits as well. So yes, absolutely. We apply the same level of discipline and conservative approach to our budgeting and underwriting that we do here on the investments.
Awesome. We have a question here from Linda, and this is a fun one. It says, read any good books lately?
Yeah, lots. I for those who don't know, I read a few books a week. So right now I'm reading a few interesting books. I just finished a book actually I really like, and actually ties in with this training coincidentally. It's called The Road Less Stupid by Keith Cunningham. And it's about dedicating time to thinking. And a big part of it is related to mitigating risk and asking the questions people don't typically ask. And this guy actually has a lot of real estate background who wrote this book and had some hard lessons because he didn't ask the right questions and didn't appropriately mitigate risk. But it's a very interesting book. I'm also reading Malcolm Gladwell's new book, and he's written a lot of really interesting books called Talking to Strangers. It's a really cool book, just came out a week or so ago. I really enjoy. He's got some really interesting perspectives that kind of change your thinking to society and drive and motivation and a lot of different topics. It's a really interesting book. And then on the family front per se, or home front, I'm in a small group in my church, and right now we're reading a really great book called Sacred Marriage, which I highly recommend, by Gary Thomas. Sacred Marriage, really great book. So those are a few that I'm reading right now that I'm really enjoying. And then as a company, we just finished reading a book called The 5-Second Rule by Mel Blount. Really cool book on kind of kickstarting yourself by using the 5-second rule, which is anytime you kind of don't want to do something, whether it's getting up early in the morning or working out or whatnot, just saying to yourself 5, 4, 3, 2, 1, go, and just making sure to get up and take action, not procrastinate. It's a simple concept, but really powerful book.
Awesome. We have one here from Ryan. It says, I've seen other funds out there, some by well-known people, where they're going after luxury property or A-class property, saying if they wouldn't live there, they don't buy it. What are your thoughts on that? And is that sustainable?
Yeah, it's a great question. And, I think, we may have, people who've been following us for a while might think we have some, aversion or we're against Class A properties. And, we own a handful of Class A properties ourselves, and we built Class A properties. We're actually building one right now, and we believe Class A can be a very, very good strategy. The problem with Class A, a couple problems with Class A. Number one, because they're easier to manage, because they're, as the member, I didn't catch the name, had just said, they're we kind of all like to own nice and pretty things, and they're definitely nice and prettier and more attractive. And, we'd all rather live in a Class A property than maybe a Class C property, as an example. But the problem is generally they sell at much higher value prices, or more importantly, at lower cap rates, meaning lower returns. And then the other major problem is everything that's being built today is Class A. So one of the big advantages in Class B and Class C where we invest is there's no new product being created. There's no new supply, meaning there's no new competition. And so we're investing in markets where demand and population and jobs are growing, and there's no new product for people to live in that they can afford. So it creates a very good dynamic for us, because we believe even in a recession environment, the demands can be really high. But because you can build Class A, and there's lots of Class A being built in a number of markets, there can end up in a situation where there's more supply than there is demand, especially in a recessionary environment when people want to live in a more affordable place. So a lot of the markets we'd all like to invest in that are nice places to live and nice communities, markets like Atlanta, or right here, even Jacksonville or Miami or Tampa or Raleigh or Charlotte, these nice markets, these bigger cities, lots of people are investing in those markets, and there's tons and tons, thousands of apartments being built in every one of these markets where we could run into an oversupply, which is a major, major risk and problem. So we believe in investing in Class A if you can do so in a market where you can be extremely confident there's high barriers of entry and there's going to be more supply or more demand than there is supply. Example, we're building an apartment community here. We're just starting in Wind Gap, Pennsylvania, in our hometown of Lehigh Valley. And there's no new Class A product being built within a 10-mile radius of that property. And there's lots of growth and demand there. So we believe it's going to be a great investment, and short-term and long-term in that case. So we would like to do more Class A, but it's got to be in situations where we can buy it at a great value or build at a great value, and we're very confident in the long-term supply demand within that market.
All right, so we have two more here, but again, feel free if you have something, get it in the chat and we'll get it asked. But here's John, and he asks, have you ever had a property that didn't necessarily check all the boxes on paper, but your gut told you to move forward and purchase? If so, or if not, any regrets?
It's a great question. I'd say the short answer to that question is no. I'd say the longer answer is we certainly have had times where at the point of putting in an offer, we may not yet have been able to check every box yet for a variety of reasons. So we made, very conservative assumptions, and then, we dove deep into those areas of potential risk in due diligence. But no, I can't ever say that we've actually completed due diligence on a property and decided and committed to moving forward on the property where we weren't, 100% comfortable, or we had a, feeling of, uncertainty or ease, in that investment. That's a great and interesting question.
All right. Well, this is the last one I see here. Victoria says, sorry if this is a very basic question, but what is common equity? I know you said it's money behind the fund, but what does that mean?
Yeah. So what it means is that, so that the fund in that example puts in $3 million of equity into a property. It means that another investor, which I'll describe, put in another, say in that example, $1 million. That means that when we sell the property, and we sell a property for $10 million. Now we have $10 million come in. We had to pay closing costs. Let's say now we're down to $9.5 million. Let's say we had a loan for $6 million, like in the example. That leaves $3.5 million. Well, if there was $3.5 million after we paid off our loan when we sell a property, yet we invested $3 million of preferred equity and $1 million in common equity. So let's say there's $4 million invested, but after we sell the property, we pay off the loan and the closing costs, let's say we only have $3.5 million left. That means we don't have enough to give all the investors their money back. And this has never happened, so nobody get alarmed, but I'm walking you through the example. If we were in that situation where there's less proceeds, meaning we're selling the property for a loss, the fund would get their $3 million back, and get generally a 12% return on their investment before the common equity would even get a return of capital. So that common equity, the money invested by another investor, is going to shelter the fund and make sure the fund gets its money back and still gets a good return, even if the investment turns out not to be a very good investment. And that common equity could be me. So there's been a number of deals where, I've invested the common equity sheltering the fund, or it could be, and this is how some of our deals come to us, another real estate investor, another sponsor brought us the deal. And say an investor got a 300-unit apartment community under contract, and he comes to us for capital, and we put in $3 million of capital, and he puts in $1 million of capital. His money will be common equity. Ours will be preferred equity. We'll get our money back before he gets his money back, just like the example I just described.
All right, Don. So we did have one more come in. If you want to take it, it's from Mike.
Sure.
It says, what plans are in place for the company and our investments if you should pass? And secondly, what are your priorities respecting the business, investors, family, and church? That second part was basically where are your priorities in terms of those four things?
Awesome. So in terms of what, if I get hit by the proverbial bus, so we have a large life insurance policy in place on me right now that goes to the benefit of DLP Capital Partners to create a ton of liquidity for the funds, for the company, to be able to handle an appropriate wind down of the assets, to be able to. So in our lending funds, the loans are only short-term loans, so they naturally pay off. And in the preferred return equity fund, our equity funds, it'll give us lots of liquidity to be able to not be in a rush, to be able to maximize the investments and then be able to sell them over the period of the investment as per the original business plan. We are in the process right now, and as you saw a few slides ago, we've been building out, a really amazing executive team and leaders who are, we now have multiple presidents running our different business units, and really ultimately the CEO of DLP, who ultimately will take over from me, is going to be one of the leaders who steps up from within the business units, assuming I don't get hit by the bus. That's just the natural plan. If I were to get hit by that bus today, as I said, we have a lot of life insurance. We'd be able to sell the assets or have the loans pay off and return investors, great returns. We are also in the process of putting an advisory board structure in place, and part of that will be having a search or a placement committee that if something were to happen to me, that would be able to replace me as the CEO and potentially continue forward. Bob Peterson is our CFO and also co-trustee of my personal estate with my wife. And Bob, actually, his last company that he was at for 37 years before coming here, handled the owner passing away and handled the effective wind down of all the investments and returning great returns back to the investor. So we have experience in doing it. And I won't tell you yet today, we have a succession plan 100% complete, but it is in process. And we do have great protections in place to make sure investors suffer no losses and get, return of capital and great profits. And then in terms of the second part of the question there, so in terms of my priorities, we train a lot on this within the organization. We live this here as for myself and our leaders. We have one of our core values is living fully, and we talk a lot about here at DLP about work-life integration, and I believe that you can be extremely successful and have multiple, we use the word in a positive way, obsessions in all aspects of your life and execute on all of them. So it's no longer, especially with technology and so forth today, where you have to say, all right, I'm going to focus on work and I'm going to have to let my family life or my faith or my physical condition, sacrifice so that I can, get ahead in my career or my business or so forth. So, I put tremendous focus on my obsession of being, the greatest father I possibly can be, each and every day. I put tremendous effort, hence even the book I talked about a few minutes ago, and being the best husband I can be, being the best leader within my church, and certainly here in the organization, being the best CEO and leader I can be for our 350 plus team members and for our clients and investors. So I have, multiple obsessions in all of those areas and others that I focus on getting a little bit better on and doing a better job and improving on, each and every, day, week, month, and year. So, so I hope that answers that question, but happy to tackle it if there's more to it.
No, I think that was it. And that is all the questions. But if you don't mind, I'm going to do a real quick shameless plug. Anyone that's listening, if you head over to YouTube and type in DLP Capital Partners, hit subscribe. We have a bunch of really fun, cool videos coming out soon. So I want everyone to get the chance to see those. That's all I have.
Awesome. Sounds great, Kyle. Appreciate that very much. Thanks everybody for jumping on, all the awesome questions. Have a great rest of your day.